Welcome back to Parliament here on NDTV Profit. We're going straight across to Alka Anbarasu, Vice President, Financial Institutions Group at Moody's Investor Service, joining us on the phone line from Singapore. Many thanks for joining us this afternoon, and we're focusing on your recently released report, Indian non-bank finance companies, which we call NBFCs, how they're going to have to balance strong growth with rising risks. And we'll start with demonetization and the short-term pressures that it will exert on NBFCs. What does your report detail on that front? The pressure points, how they'll manifest, the duration for which they will.
Sure. So on the short-term implications, there are a few aspects that we want to highlight here. So one is asset quality, where we have seen a dip in collections, especially in the rural and the semi-formal economy-focused segments, such as tractors or micro loans or small SME loans. And we expect some asset quality pressure for NBFCs which are focused on these segments in the near term. The other implication has been on growth, where clearly growth has come off in the months of November, December. Growth has rebounded, but still remains below historical growth rates. And we do expect that near-term basis, growth will also see some downward pressure as a result of demonetization.
So, when we're talking about duration for which this pressure will exist, any sort of assessment on that front?
I think it's somewhat an evolving target on the implication, but we do expect the implication will probably unfold over the next 1 to 2 quarters. So by next 1 to 2 quarters, we mean sometime by around September or so in this year. Already in this quarter, which will be ending by March, we do expect some of that asset quality pressures will come through. But it ultimately depends on how soon the remonetization process is taking place and how soon these players whose business have been affected can really come back to normalcy as well.
Okay, what are your specific insights when it comes to loans against property and how NBFCs are placed there? So we've highlighted this multiple times in the past as well. We do see there are some risks emerging in this segment. This is a segment which is growing quite rapidly. The number of players operating in this segment has increased substantially over the past few years. While the segment itself is largely collateralized, we expect that underwriting standards are starting to differ from player to player. Also, much of the loan exposure in this segment is based on what is called as surrogate income basis loans, so based on assessment of the individual's income rather than the reported income, where there is some qualitative factors and judgments involved here. So we do expect that there is some loosening of underwriting processes in this segment, and the risks are gradually increasing. In fact, some of our data points do show that delinquency rates in this segment have started to rise up in the near past. Alka, I'm not going to only focus on the risks. I'm first focusing on the risks and then on the fact that you don't believe that the growing franchise of NBFCs will be derailed. But while we're on the subject of risks, are you anticipating greater competitive pressures from the banking sector? Sure. Yeah, I think on that front, we do expect that competitive pressures from banks will increase. Already, when we look at industry data, banks' retail exposure is growing at the same level as NBFCs to a large extent. While overall, when we look at the data for the banking sector, perhaps their assets or loans are not growing much, perhaps 4 to 5% based on most recent data. But retail lending for the banks is growing by over 15%, which is the rate at which NBFCs are also growing. We expect the competitive pressures from banks will remain intense because they will want to target this segment to offset some of the weakness that they are also seeing in their corporate lending. In addition, some of the retail lending is also more capital efficient, and hence we expect that banks will try to push more so on the retail lending side, particularly housing loans, loan against property, and such segments. Okay, so which brings me back to a statement in your report which says that despite what we've just discussed, none of this will really derail the growing franchise. I mean, demonetization included. Can you flesh that out?
Sure. Yeah. So from a overall franchisee perspective of the NBFCs, or in this by this definition, we also include housing finance companies or finance companies in general in India. We do see that there is a certain niche target segmentation for these finance companies, and this target segmentation will preserve despite all those risks that we talked about. There is a significant amount of underpenetration in the loan segments across the different loan segments, and some of these segments are which the banks are unable to serve on their own as well. In addition, while banks are growing rapidly on the retail credit side, their overall balance sheets do remain under challenges. And hence, we do see that the overall franchisee of the NBFCs will continue to grow despite those short-term momentarily issues that we have seen in the market.
So then, what are the insights you can share with our viewers on the profitability and capital piece when it comes to NBFCs?
Sure. So on capital, we do broadly expect capitalization profiles will remain stable for the NBFCs. We have in our report compared the capitalization profiles of NBFCs across different segments. And in general, Tier 1 ratios is over 14 to 15% for most of these companies. This contrasts with a Tier 1 ratio of about 8% for the public sector banks. So on the capitalization front, NBFCs remain fairly well capitalized. Nevertheless, a strong growth would mean that NBFCs will need to continuously find external sources of capital. When it comes to profitability, again, broadly for the sector as a whole, we do see that profitability will remain stable. ROAs are in the range of about 2%, which is significantly higher than when we compare ROAs of 0.4 to 0.5% for the banking sector. Having said that, on the profitability front, there is a significant difference if we were to look at individual NBFCs. And these differences mainly come from a few factors. So first is their credit cost and where they are in the credit cycle. The second is their operating efficiency. And third is their ability to manage funding costs.
Okay. Well, I'm going to leave it at that. It's always tempting to continue to explore various aspects of this. But Alka Anbarasu, Vice President, Financial Institutions Group at Moody's Investor Service, many thanks for your time today and insights.